Now we move into section 7.3, outsourcing. Outsourcing occurs when a business purchases a product or service from an external supplier rather than producing it in-house. To evaluate outsourcing, we compare the vendor purchase price versus the relevant costs of producing internally. Only costs that change matter. In addition, we must consider opportunity costs if outsourcing frees capacity to do something else. There are 3 steps to consider when thinking about outsourcing. The first step is to determine the difference in costs under the 2 alternatives: produce in-house or cost to outsource, buy from a supplier. The next step would be to consider the opportunity cost from the potential benefits that might be derived from the capacity created by outsourcing. And the final step is to choose the alternative: produce in-house or buy from a supplier. That has the lowest cost after considering any opportunity costs. Now let's look at the Blackhawk custom cycle outsourcing example in your book. The in-house cost per engine is $710, while the vendor offers engines at $985. At first glance, outsourcing appears more expensive, but we must identify which costs are actually relevant. Some fixed overhead may not change if production stops, and those costs should be excluded. Then we must consider opportunity cost. If outsourcing frees up capacity to produce more motorcycles and earn additional profit, outsourcing may become the better decision. If we look at the breakdown of the cost per engine, you can see that direct materials are $350 or $175,000 total cost. Direct labor is $245 per engine for $122,500 in total cost. Variable overhead is $55 per engine for $27,500. Fixed manufacturing costs are $30,000. So in total, manufacturing costs of 500 engines results in a cost of $355,000 or $710 per unit. If we compare that to purchasing engines at $985, 500 engines would cost $492,500 to buy. The difference in cost between buying and making engines is approximately $137,500. Initially, it appears that making engines in-house would be the better choice as it saves money. However, we realize that the capacity that is created by outsourcing engines would allow us to produce 40 more motorcycles and earn additional profit of $140,000, which must be considered in the decision. That is an opportunity cost, and that should be added to the cost of making engines in-house. So now the revised incremental cost of making engines, including the opportunity cost, is $495,000, which is more than the cost of outsourcing by $2,500. So outsourcing now becomes the better decision. There are, of course, additional considerations. Quality and timeliness are critical when evaluating outsourcing. Management must ensure that the external supplier can deliver on par with in-house production. Now let's complete learning activity 7.5. Retreads produces sandals in-house and is considering outsourcing to Yangzhou Industries. You were asked, how much more or less profit will Retreads earn if it outsources? And 2, if Retreads can sublet part of its factory after it outsources for $4,000, how does that affect the decision? Be careful. Some fixed costs are unavoidable and are not relevant to an outsourcing decision. Some fixed costs may be avoidable and should be included into the decision. Also consider the sublet revenue as an opportunity cost benefit of outsourcing. Here is some additional data you will need to solve the retreads example. Please pause here and work through the activity. Once you've finished, check your answers with the solution provided in the back of Chapter 7.